that we can record this for the website later, but today we have Jim Kelly with us. He'll be talking about the business model and revenue projections, which we're really excited about. And then I'll make a few announcements at the end of the workshop. But please feel free, if you have questions along the way, to please put them into chat. As Jim talks, I'll be interrupting him along the way to answer your questions so we can make this a really interactive session. So Jim, please.
Thanks very much, Nikki. And yes, I really do want to make this interactive. So at any time you have a question, if I'm, just go ahead and put that in the chat so Nikki can alert me and I can answer it. Very quick introduction about myself. I've had a career that spanned international nonprofit work. I currently work at UC Davis in a budget and finance management role. I've also worked in companies doing finance and strategic management. Probably the most relevant work for the conversation today is for a time, I was valuing small companies as targets for acquisitions. And so as we look at the business model, one of the questions that we'll get to at the end is seeking investment and how do investors look at your business in terms of the value of that business. So we'll get into that closer to the end, but that is definitely something that I have enjoyed working in. It's always fascinating to me about how do we think particularly about companies or businesses like yours, where a lot of the question is about the future and future projections of earnings. But let me begin by sharing a deck that we will use to work through today. And so we're looking at the business model. And to be clear, what we're looking at is how you're going to make money, where you're going to spend money, and what are you going to do with what's left over. Okay? So the learning objectives for our meeting are defining and articulating your vision in terms of the business attributes. Developing a plan to validate that vision by recognizing and resolving the biggest business uncertainties. One thing that money does not like is uncertainty. The more certainty you can bring to your business, the more money or the more value the market will attribute to it. Okay? And therefore, you will want to think about how much money do you need to get your project going off the ground and get it to success? How much do you need to raise? How are you going to raise it? How are you going to return it? And a related question to all of this is, when do you need to raise it? Okay, so in terms of learning objectives, does anybody have a specific question about business models that you do not see addressed here? Or is there a particular piece of this that you really want me to do a deeper dive on? You can unmute and ask or put it in chat, your choice. Okay, I'm going to proceed. But as we go, if you do, here is one question that just showed up.
Okay, so we have one that says how much you need to raise is of interest. Where do you show how you plan to pay back the investors' money? And then I'd be interested in learning more about hybrid models or for-profit businesses that have social impact. And then especially that you have an international development background.
Right. Okay. We will absolutely develop a question of how much do you need to raise. That'll come from the business model that you develop. We're absolutely going there. We're going to talk about paying back at the very end. Okay, so please be patient, Ms. Wilson, but we will get there before the end of the time. And Kidan, we can talk. That is not something that this will specifically address, but it's a really interesting question of the types of models that are being developed for, social impact companies or, B Corps and that kind of thing. I have some thoughts about that. It won't be the focus today. If you want to stick around and ask a specific question after the end, I'd be happy to do that. Okay? Okay. Great. Oh, and we will identify the specific next steps needed to move forward as a learning objective. So the most important thing to come out of this session is your specific plan, your unique plan on how you're going to proceed, okay? Now, the focus of your business plan, right? It is the combination of your specific technology, and we're using the technology in the broadest sense here, okay? Could be a service, a product, a specific technology. What are you bringing to the market? Is it feasible, right? Question one. Number two, the market itself. Does your market see what you're doing is desirable? It has to meet a need, or why would they buy it? And then you need to join with that the question of, is your business viable? Viability of a business is a little bit different from a viability of a nonprofit, right? All a nonprofit has to do is get to zero. Revenue, expense, zero, we're all good. A business has to generate profit because investors expect a return. So I want to take a moment here to ask you some questions. You don't have to answer these, but I want you to pull a pencil and a piece of paper out and think about your business idea. If you don't have a specific business idea, just imagine one. And I'm going to ask several questions that I want you to think, do I know the answer to this? I'm going to pause after each question. Do I know the answer to this question? If I don't know it, how am I going to get the answer? Because everything about your business plan depends on you being able to answer some of these questions, or actually all of these questions. Number one, for your technology, what are you replacing? What are you replacing? And I'm going to say something provocative, which is a lot of entrepreneurs think, I am brand new in the market. What I'm doing, no one else has done before. I'm not replacing anything. I'm bringing something brand new. That can't be true. This simply can't be true, because if you're addressing a real human need, which is the only thing worth doing, then people are getting it met somehow. Okay, people are already getting it met somehow. However you think about your business idea, people are managing it one way or another. So what are you replacing? What's the status quo that you're replacing specific to your business idea? Okay. How much does that current solution cost the people involved? Okay. What is the price of the current solution? And you can think about that a lot of ways, because maybe it's not a price of a specific product or service. Maybe it's a price in terms of aggravation. Maybe it's a price in terms of lost efficiency. But what is the price of the current solution to the human need that you're trying to meet? Okay. Third related question. Going a little bit further down the rabbit hole, what are the switching costs to go from the current status quo, the current solution, to your solution? Because there are always switching costs. They could be very low. The barrier to change could be very small. It can also be very high. And for your business model, you're going to have to address getting people to change how they solve the problem. Okay? It's got to be cheaper. It's got to be better. It's got to be less aggravating. It has to be better than the current solution, enough better to warrant people purchasing your product. Okay. So that's the first set of 3 questions about your technology. Here are a few others about your market. Okay? Who makes the buy decision? This is a deceptively easy question, because we oftentimes think in the development phase of technology, here's the problem I'm solving. But in a lot of cases, the problem you're solving is the person who benefits from that is different from the person who makes the buy decision. And Maya, I'm going to use yours as an example. Okay? I'm pretty sure I can guarantee that nobody who shows up in an emergency room and will benefit from your better coding is sitting down with a catalog deciding what the coding is that they want on their catheter, right? It's a huge benefit to that person. The buy decision has already been made well before that moment. It's probably been made by a hospital administrator. So the person you're trying to help is the patient, The person making the buy decision is different, okay? So who makes the buy decision for your technology, your service, your product? Second question, what motivates that person, right? What are the motivations for that person? A hospital administrator might be motivated by cost efficiency, cost effectiveness, right? They might be motivated by fewer infections. Let's hope hospital administrators are thinking about that. And maybe I don't understand that business at all, and it's not a hospital administrator. Maybe doctors get to choose what catheters they use. But anyway, I think that's a deceptively easy question, but you need to be able to answer it. Who makes the buy decision? I was working on a kind of interesting technology project quite a long time ago on a product that would schedule the use of laundromats. So instead of showing up on a Saturday morning with every machine occupied from the comfort of your home, you could figure out when a machine was going to be available. You could lock it up, schedule it, show up, throw your clothes in, get them washed, and leave. Okay. Turns out probably most uses of washing machines are in apartment buildings and college dorms. So it's not necessarily the retail customer who was the customer for that product. It was actually the people making decisions as to what kind of machines to put into institutions. And the selling point for that device was that you could get away with fewer machines in a college dorm, which meant less real estate devoted to laundry machines, which meant more real estate devoted to rooms for college students, more revenue, right? So hopefully, over all of my talking, you've had a moment to think about your business in those terms, right? What are you replacing? What's the cost? And what's the switching cost to go from the current solution to the new one? Who makes the buy decision? And what are their motivations? Okay, because that's essential to beginning to think about the next steps in your business plan. The purpose of your business plan is twofold. Number one, for you and your team, however you define that, it is a dynamic guide to developing your business. So today we're going to talk about various assumptions you can make and ideas you can develop for your business plan. A month from now, I hope you're going to know more and you're going to change that business plan. But the general direction of the business plan is going to keep you on track. It's going to tell you what the next question you need to answer is so that you can keep developing your business. That's purpose one. Purpose two, very important for outside business audiences. It's the story you're going to tell for potential partners to convince them to invest alongside you. Okay. It is, in fact, the most important tool you have to raise money for the investors. You need to be able to show them that you know your business, that you've thought it through, that you have convincing support for it, and that you are the person that you can be the investable opportunity that will make them money in the future. Okay? So we start with a business hypothesis and some key questions. So your hypothesis, you've got a technology, you've got a service, got a product. Is it achievable? Will it be profitable? And is it scalable? And that scalable piece is important because a lot of businesses can operate at a very small level, but will it really be worth it until you can scale it? And scale is what's going to draw in investors. Altogether, it's viable. Your challenge as an entrepreneur is to validate all of these assumptions in your hypothesis for yourself, but also for the other consumers of your business plan, your team, and potential partners and investors. So, key questions to answer. How will you make money? How much will you make? How much will making that money cost? Because what do we call the difference between the money you make and the costs? That's called profit. Okay? And then important for understanding when you need to raise money is when will that happen? When will you make money? When will you need to spend money? And when will you be making profit? So at the end of this, I'm going to pause so you can take a little time to think about your business opportunity and your business plan and make a few notes to yourself, okay? So how will you make money? here's a short list, 7 ways that businesses typically make money. Call it revenue models, okay? And one, very common, unit sales. You sell a product or a service to customers, either wholesale, right, like business to business, retail. You are selling into a retail space, or direct to customer, maybe over the internet. Okay, that's unit sales. You can make money by selling opportunities to distribute messages, advertising fees. So you would look at what's the unit there? It's viewers, readers, listeners. Okay. You can create a replicable business and then sell that opportunity to other people with the know-how, the models, some of the background systems. So you can sell and support a replicable business for others to invest in, grow, and manage, right? That's called a franchise, and then you charge them a fee for that. That's a franchise fee. So that's another revenue model for an idea. Like Ms. Wilson, I don't know if this would be an opportunity, if you have sort of a small scale operation to get to energy from end of life textiles, but maybe you develop that business model into something that's like a pre-packaged business that other people would pay you for, and then build a brand off of. Utility fees, right? This is where you sell goods and services on a per use basis. Subscription fees, where you have a recurring fixed price for providing access to your goods and services. Think a lot of software these days, software as a service. Transaction fees, you charge a fee on top of another transaction, either as a referral or executing the transaction. And then a final revenue model of these examples. There's other ways to make money, but this is another example of how a lot of entrepreneurs have constructed their revenue models, is licensing fees. So you have some kind of defensible intellectual property. It's either patent protected or copyright protected, and you can sell the rights to others. It can be exclusive, so essentially you are handing off your IP and only this other entity can use it for a period of time or in perpetuity. Or non-exclusive, where you're licensing something, for example, a copyrighted piece of work, piece of art, okay? So that's 7 examples of revenue models. And what I want to give everybody about 2 or 3 minutes to do now, I will be silent, is to think through which of these seems most applicable to your business, and what do you need to know next about your business to consider which one you want to choose.
Looks like there's a question in the chat, and it says, which one of these applies to white labeling?
So white labeling could be done in a variety of ways, right? And let me just, if the person who asked that question wanted to give me a for instance, that might help, but I can also just spin off a couple of white labeling instances that I know. That was asked by Jane.
Yes.
Sorry, Jane. Sell a framework, like is it a protectable framework or more of a business idea?
More of a business idea, if you were to sell that to a business that they would then utilize with their employees or third parties, and possibly they would white label that. They don't want your name on it, so
Right.
Mm-hmm.
So white labeling in that instance is you could choose a variety of these revenue models for it. Probably a license or a subscription fee would be one of the most obvious ways. So for example, I can think of, I'll give you a for instance, like when you have Wi-Fi in an airplane, right? That is a white labeled service that each of the airlines puts their brand on. Okay, Delta Wi-Fi, United Wi-Fi. That is probably something like a utility fee, like the company that sets it up for the airline, installs it in the airplane, makes sure it keeps running. They sell that on a per use basis. There are other ways that, like a licensing fee. So for example, like Salesforce, right? You might see Salesforce down on a little copyright thing, but or Oracle, when they have a major program or an installation of an ERP, they the company is going to label it their ERP, but the licensing or subscription is being paid to the company that issued that service or utility. In both of those cases, and this is the thing about white labeling, is there's something underneath it which is defensible and protectable by the company, right? It's not just an idea or a framework of thought. It's either a copyrighted code, patented product, so that the company buying it can't just reverse engineer it and repeat it without continuing to pay that fee. Was that helpful, Jane? Did I answer your question?
That's great. Thank you so much.
And I only say that because business is business. And if you aren't protected, a lot of businesses are going to take the IP and repeat it, right? Unless you have a way to protect it. Okay. So the next question, and I'm going to move pretty quickly here. I realize we're already halfway through. The next question is, how much money will you make? And this is the first question, gross revenue, first question in your business model. And it'll depend a little bit on the specifics of your revenue model. So unit sales, it's how much are people going to pay for your unit times the number of units sold. All right, so as you're planning out, you're thinking, what can I ask? How many will they buy? Advertising fees, that's just price per view or click or action, and then the number of views. A franchise fee, what is the fee for the franchise, which you can structure in a variety of ways. It can be either fixed or profit sharing, times the number of franchises. Utility fees is price per unit times number of units consumed. A subscription fee, price per service times the number of services or length of time is also a factor in there. Transaction fees, what's your fee per transaction, number of transactions, and licensing fees, right? And although here it's posing it as a fixed amount or percent of sales, when you get to your business model and you're projecting revenue, it's in dollars. So if you say, yeah, I'm thinking I'm going to get 5% of sales, you need to be able to translate that into, if I have X number of licenses and it's a percent of sales, what do I expect the dollars per sale to be so I can get into a dollar amount for my gross revenue? And then the third big question in your business model is, how much are you, based on the revenue model, what's it going to cost for me to get there? How much will it cost to produce these things? And in these cases, given that we're usually talking about something new, what's the development cost? In each of these revenue models, I have to develop something and then get it to the market. And then if it's a unit sale, I have to think about, well, what's it going to cost me to produce each unit? And then what are my cost of operations in addition to that? In classic accounting, we call that cost per unit sold, COGS, costs of goods sold. For a lot of these, it's just the development cost plus the cost of operations, because to deliver each individual unit of the product, there's not that much incremental cost, or it's not worth tracing it back to the individual instance. Advertising fees, development and cost of operations. Franchise fees, development cost of operations. But the utility fees, again, you introduce cost per unit sold. Same with subscriptions. What's the cost per unit sold? And then you have transaction licensing. So once you have developed these two ideas, revenue and cost, you're ready to start putting it into your model. So I'm going to pause for just a second and give you a couple of reflection questions and a minute to think about them or ask a question about them. Number one is, how will you decide the revenue model for your product? And it's not determinative. In other words, you don't have to follow what's been done before, but it's important to know what is the revenue model of the status quo. Because if you're going to replace the status quo, you either want to pursue what others have done before to provide the same service or product, or what you want to do is create a new channel to the market, which might be harder, but it might offer unique benefits. Okay, so think about that and whether you know already what the status quo does to deliver the replacement product or the status quo product to the market. Okay. And then I would say, how are you going to, now that you think about the revenue and the cost, how can you start small to validate these assumptions? All right, and let's go there. How do you estimate revenue and costs? And the solution is this model, which I expect, Nikki, they have already seen in prior presentations. Am I wrong?
Yes, for those who have been in prior workshops, they have seen this.
Okay, and it's a simple model, but it is so important for entrepreneurs because entrepreneurs can think so big and they've got the final vision in their head. But to get there, there's this iterative process. And you can either get lost in the thinking or lost in the doing. If you're lost in the thinking, you never move. If you're lost in the doing, you never learn. So it's really important. And this model, especially what I love about the Institute for Innovation and Entrepreneurship, is they really push this model of test small, learn early, right? So when you're estimating your revenue and your costs, start trying small experiments or start talking to people in your market, customers, buyers, who's the clients whose problem this is going to solve, to learn things like what are they currently paying, which, how do they view your product compared to the status quo product or service, and then build out with what you're learning. And again, it's going to be dynamic. It's going to change as you learn things. Build this out, back of the envelope, the $5 version, the $50 version, the $500, the $5 million version. Define a clear vision. You won't have enough information to have a clear vision. You still have to do it. And then test against that clear vision. Okay? Everybody, when they're building something new, doesn't know everything that they need to know. But you will learn as you go. Just keep that process going. The other piece of this model, which is really helpful, is use a 3x5 model, okay? And I think Nikki will be able to share with you some worksheets to build this out for your business idea. What are the 3 most important drivers of revenue and expenses, and how will they change over 5 years? And by change, I mean as your business grows, right? What are your projections for year 1? What are your projections for year 2? So not in terms of how they'll change, like how's the world going to change over the next 5 years. If any of us can predict that very, very well, you can make a ton of money and should probably get off this call. But what we do know is your business, your vision for your business is that it will change and grow over time. So here's an example of what that could look like, right? Here's a business. They're thinking they're going to start selling something. It's going to start off where they're going to sell it at $25 in year 1 and then decrease the price as they go. They figure they're going to have 500 customers in year 1. They're going to build out to 5,000 customers in year 5. And the average number of units per customer is also going to grow. Okay. Understandably, you're going to have to start with a smaller customer base. Maybe they won't buy as much because they don't have enough experience of your product. But over 5 years, can you grow it? Can you grow the customer base 10 times? Can you grow the number of units they purchase 4 times? And as that goes, you might be able to lower the price per unit because either you're offering volume discounts, and that's what people expect, and or your cost of production is going to go down. Okay, so customers, units per customer, and price per unit in this particular business model are the three most important revenue factors. So 3 revenue factors, 5 years. Expenses, what are your 3 most important expense factors, right? Cost factors. Headcount for this particular business. They've projected their human resource needs over these 5 years and built out the model. They projected that they're going to start at $18 production cost per unit and get it down to 14 with economies of scale and efficiencies. Customer acquisition cost, what's it going to cost to get those first 500 customers, right? $325. Or we might be working in, we're working in thousands here, so $325,000. And as you build brand reputation, as you build out your marketing machinery, and as you get repeat customers, that customer acquisition cost is going to go down. The idea here is that to get that last 1,000 customers from year 4 to year 5, that's going to cost you $50,000, whereas the first 500 customers cost you $325,000. What that gets you to is net income or profit, more simply stated. And as you can see, this is a typical 5-year projection for a new enterprise, a new business. You might lose money in the beginning. You don't have enough customers to cover all of your costs, especially those customer acquisition costs and some of those production costs. But by year 5, you're clearing $850,000 after expenses. Okay, so it's a very simple model, very powerful model. Okay, when you start, your initial approach to developing these revenue and cost items should be bottom up. Okay, the most important thing you can be doing at this stage in your business model is going out and meeting people in the market, either people who are in the business or potential customers, or the people whose problem you're solving. So starting with bottom up, asking the questions to gain specific estimates of key drivers of revenue and costs. How many customers are going to buy this? I'll just say one thing. Well, I'll get to it later. But generally speaking, people are nice people. And if you say, hey, do you like this product? They're going to say, yeah, sounds great. Okay. You have to get more precise. You have to get down to specifics and put them in the business, put them in the position of challenging whether this is the right price point, whether this really can be produced for X. Okay. And then you also need to figure out your plan of sales growth. What's that going to mean for staff and other costs? And here's where having partners who've been in the business, people on a board of directors who you trust, who are known, can be super valuable. Okay. Then as you build out that bottom-up model, the top-down, okay, test those results against a top-down view. So you've got this cost and revenue structure now, but how big is the current market? Again, who's the buyer? How many of them are there out there? How do I capture it? What's the real market available? And if that's how big the market is, how much of it do I think I can capture in year 1, in year 2, and out to year 5? Okay. And it's really critical that you're able, when you get in front of investors and other potential partners, to be able to explain how you got to the numbers that you have, that you're presenting to them. They will ask questions. Who'd you talk to? Where'd that number come from? Why do you believe that? Okay, so it's crucial that you have these conversations now. So to build that confidence in the numbers, start with real customer feedback. And I want to say again, pay attention. Are you asking the person whose problem you're solving? Are you asking the person who will buy the product? They might be 2 different people. Okay. A real market analysis. How do you figure out what your total available market is? That's TAM, right? How big is that total available market? What's a realistic projection on that TAM? Call that your obtainable market. Okay, is it realistic that I can get 100% of it? Generally, no. Where are you going to start? Is it geographic? Where are your customers, right? Are they in geographic locations? In which case, how do you start? How big of a market are you going for before you start to expand out of that geographic area? Are they online, right? Where are they making the buy decision? Is it online? Is it in a geographic location, in a store? So that's important to figure out your obtainable market. Another piece that builds confidence in the numbers is a working prototype, right? Being able to demonstrate that you can solve someone's problem by solving their problem with a prototype, okay? And then you've been able to present that prototype to a couple of customers, people who might buy it, adjusting based on their feedback. Right? What are they really telling you? And here you need to encourage brutal feedback. Not just, oh, that's so wonderful. A lot of people are going to try to be nice to you. You need to get them to be blunt and brutal. And I say that because the best thing to build confidence in your numbers and your business plan is going to be a sale, right? Talk is cheap. It costs nothing to anyone to tell you how great your product and service is and how much they hope you get it to market. Once they're buying, you have real evidence that you can turn this into a business. And what's better than a sale? Anybody want to guess? I'll give you the answer. It's more sales. Okay. Your first sale is great. Keep building on it. Get momentum. Demonstrate that you can scale this thing. Okay. More sales is the answer to what's better than a sale. Nothing like market proof that people want to buy your product. Okay. Oh, and I saw somebody put profit. Yes, if you have lots of sales and no profit and no future vision of profit, that's a problem in your business model, but a separate problem from getting the first sales. So what I'm going to turn to now is, and I'm going to actually flip back a few slides. The question of when do you need money? When do you need investors to come in and give you money to build out your business? Well, if I'm looking at this revenue projection, this business model, I either have to have, roughly $600,000 available to invest in my own business, or I have to go out and find somebody, because I'm losing $22,000 in year one, $479,000 in year two, $85,000 in year three. I'm not turning a profit until year four. And even at the end of year four, I'm basically breaking even over the last 4 years. It's not until year five that I'm actually returning anything from my business idea. So either I'm self-financing, but I don't have $600,000 for this, so I'm asking other people for it. Okay. We call this the J curve. It's shaped a little bit like a J, and you have net cash flow. In other words, the way this is built is the idea that maybe you're starting with a research grant, which is great, free money and no expectations of a return. Some development grants are similar for applied research, but then you're going to start moving it into a business, not just developing. There you're going to have to find proof of concept, target market, business plan, moving further along, working prototypes, the founding team. And this is not a necessarily, this isn't the only way to get there, but frequently people start by self-financing. Or if you have family that have some money and they believe in you, they could give you some money. So friends, family, and founders might be the first place you get a little bit of capital to build out. This might be sweat equity. Might be a lot of work on the weekends and you get paid nothing. The next step are called angel investors. And what that means typically is a person who's investing their own money in your business idea. Okay. And as we move down this scale, people know you less, people know less about your specific business, and they may care less about your specific business. Typically, friends, family, and founders are investing because of you, or they may really have similar values to you and they really believe in your business. Angel investors probably have some domain-specific knowledge, and so they believe they can help you with your business and they really care about it. By the time you're into venture capital, you've got people investing other people's money in most cases. And what do they care about? Return, profit. So you need to have a story to tell by the time you're here and engineering prototypes and starting to do supplier contracts where you can be very convincing that you can turn a profit and then deliver it back to the investors. Because the eventual source of profit, IPO, merger, or acquisition, usually depends a lot on access to public markets for capital. Public markets don't care who you are. They don't care about your product. They just care about return. Okay. We call this moment, this part under the zero line, the break-even point, the valley of death, where most businesses fail. Either because they didn't get enough money to get them through to profitability, or they fail for other reasons. Okay, but that's called the valley of death in the J-curve. So why this all matters is if you need to spend money before you can make money, then you need to raise money from other people to get there. So here's what you need to be able to do with your business plan. You need to know how much money you need and when. You need to know how much you might be able to make and when. And you need to be able to convince other people that their investment is worth it. Okay, which goes back to that 3x5, because to an investor, to somebody like me, when I was going around talking to small businesses for potential target acquisitions, basically, there were three things I was looking at, right? One was, what is the company telling me their financial projections are? How much confidence do I have that they can deliver those results? And to the extent I'm not confident in what they're telling me and they can't back it up, I'm discounting their projections. Maybe they say they can make $1 million profit in a year. If the data doesn't back it up, or they're not convincing, or I'm scared they're going to take the investment and skip town and not be there to continue to deliver, I'm going to cut it in half, or worse, a quarter. Maybe I don't see it as valuable at all. A third thing that's specific to financial professionals is what we call systemic risk. This is, okay, I believe in you, I believe in your projections, I think you're great, but your business is really exposed. Okay? Maybe it is a luxury product that people aren't going to buy in a recession. Okay? That is a very risky bet for an investor, because I can't predict when the next recession is going to come. And so I'm adjusting my expectations of your profitability based on systemic risk. There are other types of systemic risk that might be specific to particular industries, education, healthcare. If the government's investment in healthcare goes down, what does that mean for a product that depends on a robust healthcare financing system? You can control the first piece of this equation, your financial projections. And that's where you should invest most of your time, is having defensible projections based on conversations, based on facts, based on research you've done. You can influence how much confidence the potential investor has, right? By how you present, by the quality of your backup documents. You can't do much about the third, which is the systemic risk calculation. But also that's not something to worry about too much, because each investor is going to have their own estimate of that. As you move through the stages of developing your business, you as a founder will be diluted. That is fine. And that's not diluted, I should say diluted. Here's an example of where a company is founded, goes through a seed round, has a Series A and a Series B. At each stage of this, each of these rounds, what's happening is you as a business entrepreneur are presenting better information about how successful you can be, which means the value of your business is going up. You may start in that first stage of founders and all you've got is your business plan. Let's say you get that business plan perfectly, absolutely perfectly. You hit exactly the revenue numbers and exactly the cost numbers, and nothing has changed about your projected profitability of the business. The value of your business is going up every year because uncertainty is turning into certainty. So the value of your business is going up. So even though in this particular model, the founder owns 60% in the beginning and only 31% in Series B, that 31% is probably worth a whole lot more than the 60% in the beginning. So don't be afraid of dilution as an entrepreneur. It's a necessary part of the equation, and you can be really successful. So just to say, sort of the end game here is for an investor to part with their money today, because that's what you want. You want them to invest in you. You need to convince them of significant upside tomorrow. And how do investors get out? How do they have an exit? How do they get money? There's a whole lot of ways. And as they go, they may invest in you in different ways. For example, probably an angel investor is just going to want a piece of the business, a percent, okay, of the future value of the business. But you may, and a VC might do what's called convertible debt. So I'm going to give you a loan, but if you're really successful, I'm going to turn that into ownership in your company. Always have a lawyer when you're talking to a venture capitalist. They know this stuff. It's unlikely that you do, but you can get good lawyers. I think the Institute can introduce you to some good lawyers, but you want good lawyers on your side when you're sitting down with these people, because this is what they do for a living. And then what they're looking for is the exit. If they're a venture capitalist, they don't want to hold on to your company for 10 years. Usually it's 4 to 5 and they want out. Either an initial public offering, you go to the public markets, or your company is acquired by a larger company that can take advantage of the technology you've produced. It merges well with what they're already doing, and they see synergies and opportunities to buy your company for a good price. Or you can keep running that company and just generating profit, which generates ongoing dividend and cash payments. Okay. Nikki, should I go ahead and summarize and then take questions? Is that, or pause here?
Well, you're welcome to pause. I don't see any current questions in the chat, but this is a great time for any of you on the call who have a question. You can unmute, you can put it in the chat. Oh, go ahead, Erin. I think we can barely hear you if you want to.
Okay, I was speaking softly. Thank you so much. Can you hear me okay?
Yep.
Yes.
Yeah. I was wondering around when if you want to, thanks so much for the presentation. If you want to keep a hold of the business for a long time, how do you justify to your investors basically, like, let's say for the first 5 years, you're just going to reinvest profits in order to grow the value of the company? How do you, when is the point when you decide that you're going to do profit distribution, or people might get angsty for profit distribution versus higher value of the company?
I'll give you the really simple answer, which is if you can convince your investors that reinvesting in the firm generates more future value, they will absolutely be happy with you.
Okay.
Companies that we now know as giants went a very long time without any cash distributions to investors. I didn't spend any time today talking about, future value and present value. To an investor, the value of any business, any investment opportunity at all, is the present value of future cash flows. I'll say that one more time, a little more slowly. Every single investment that a professional investor looks at is the value of it is defined as the present value of future cash flows. So if you can convince your investor that by reinvesting for 5 years with no cash distributions, you will increase the future cash flows so much that it's worth what they could have taken out of the company in the first 5 years, then a smart investor will do that. They'll say, absolutely. Keep reinvesting, keep growing, keep expanding your customers. To get them to do that will require a solid business plan, demonstrated success, confidence in you as the leader and founder, right? Did that answer the question, Erin?
Yeah, that's great. Thank you.
Okay.
Great. Okay, we can continue on, Jim, and then answer
Okay,
any
well,
questions that come on.
I will though piggyback on Erin's question for one little piece of advice that circulates in that space of venture capital and entrepreneurship is a lot of entrepreneurs have to decide whether they want to eat well or sleep well. And what that means is from the entrepreneur's point of view, or do you want to eat well or sleep well? The less investment you take into your company, the more money remains in the future for you, right? Because you're going to have to give up less equity in the company. So that's the eat well option, but it's eating well in the future. The sleep well is you take as much cash as you could need, not the minimum, to get you to the next milestone, but you agree to an investment where you give away more of the company, but it gives you a cushion. Because as I said, the valley of death happens when a company might have a very successful business model and they might be making progress, but they lose momentum because the entrepreneur sees it, the cash has run out, and it could be something external to the business. It could be a downturn in the economy where all of a sudden investments drying up and people are very risk averse. And if the entrepreneur had taken the cash when times were good and investors were offering, they would have the cash to get through that J curve and start making a profit. But because they held on to the company and weren't willing to part with that equity, they wind up having nothing at the end. So it's a legitimate trade-off, and everybody has to make their own decision, but eat well or sleep well is one of the questions that entrepreneurs hit when they're looking at investing.
Got it. So you're saying like dilute. Don't be too afraid to dilute.
Don't be afraid to dilute. Don't give anything up. Don't leave money on the table. Don't give up more than you have to, but don't be afraid of dilution at the risk of never getting to the successful, above the break even, making profit, growing fast. Yeah, don't hold yourself back for that reason. Oh, and Ms. Wilson, you don't see cash flows within that first 5 years. How do you convince them? You're showing growth, showing satisfied repeat customers. You're showing a trend in your cost structure that indicates you can get to profitability, right? So maybe in your prototype, the scale is just not big enough to get to profitability. You need to double your customer base or triple your customer base. Or in the model we had before, it wasn't until I think there were 4,000 customers that they were above the break-even point. If you're able to convince, again, it comes down to your ability to sell yourself and your idea and your business model. If you can convince them that here's my 5-year plan and I am on track, I'm hitting milestones, I'm hitting benchmarks, then they will stay with you. Okay. So I'm going to go ahead and finish up these slides in a summary, and then any other questions I can stay around and answer. But in summary, the key elements of your business plan is that you demonstrate that the problem is real and causes pain. The evidence of the size and scope of the pain, the market, right? Your solution can cost effectively relieve that pain, can replace the status quo, cheaper, better, somehow. And then what is that investment that is required to bring that solution to market? Here's your revenues, here's your costs, here's the cash you're going to need to get to the break even. By predicting the growth of your sales over time and the costs, and then for the investors, showing that your potential profits are worth their investment, right? So my recommendations to you, as you build out your business plan, you need to know your product, your market, and the opportunity better than anyone else. Okay, so when you get up in front of investors, hopefully they're smart people. Some of them might really know your industry. You want to know your product, your market, and your opportunity better than they can. So every question they ask, you can answer. You need to be real about the potential competition and the real risks. Don't try to sugarcoat it because, again, their job is to reduce uncertainty. So if you're not showing that you understand risk, that introduces uncertainty. Okay? Build your business model from the bottom up and then go top down. Figure out what the total available market is. Know your customer, who you can sell your product to and why. Know the economics of your solution and how they scale, and demonstrate that profitability over time. Repeating myself a little bit here. The other piece is make the case that you are a good candidate to exit or return cash. At the end of the day, especially in the beginning of your business, when you don't have a lot of sales and you don't have a lot of demonstrated history in your company, you are who the investor is investing in, right? So it starts with you. You are central. The opportunity needs to be great, and you need to make the case for why you are the best person in the world to make that opportunity real. Okay, so I'll stop there. I can always go back if anybody had a question about a prior slide, but I hope that this was helpful, and I'll stick around to answer questions. Okay, I see something in the chat there.
Yes. Oh, go ahead.
Right. So the measuring rule for how much equity you should be willing to give up for an investment. So to the answer to that is really, it depends on your business model and how much profit. So as I mentioned, the value of a business from an investor's perspective is the present value of future cash flows. So again, I won't get into that formula, but let's just say that I evaluate your business, discounting for risk, discounting for systemic risk and everything. I think your business is worth $1 million. Well, I'm going to want half of it if I have to give you $500,000. Okay, so the formula on how much equity you should give up is basically the dollar value of the valuation, my investment, what percentage of that is it after I make my investment? Okay, so if I invest in your company, I want to know, if you're asking for half my valuation of your company, I want half the company. Okay. To understand how a professional investor might get to a valuation of your company, I'm just going to give you a phrase that I'll type in here. I don't have personally anything to recommend. It's just called a discounted cash flow, a DCF. I'm sure that there are YouTube videos on how to do one. Any intro to finance course will teach you how to do one. What a discounted cash flow basically is doing is you look at cash flows in the future, and then you discount them back to present value. So if I'm looking at if somebody says to me, I will sell you $1,100 next year, I'll give it to you 365 days from now, and my expected return is 10%, right? I'll give you $1,000 for that today. So the present value is 1,000, the future value is $1,100, using a 10% discount rate. So that is a 10-second version of future value and present value. Discounted cash flow just is essentially a spreadsheet, a table where you list your future cash flows by time period, and then using your discount rate, you bring them back to a present value. And that is how a lot of professional investing gets done. A lot of professional investors use other shortcuts. You might have heard of EBITDA multiples or revenue multiples. Those are essentially shorthand ways that investors quickly assess the value of a firm in a particular industry. So you might have a multiple of profit that is used in a utility business or a retail business, or like, for example, a veterinary medicine. I did a job for some vet med clinics where we looked at what's the appropriate multiple to purchase a vet med practice at.
That's great. I think I see a question in there from Aaron on how do you deal with sweat equity?
Split equity. Oh, sweat equity.
Oh, sorry about that, yes.
Right. So when you think about sweat equity, so sweat equity is literally just the non-cash value of your ideas and labor, right? Sweat equity is valued in your company by the profit you will create that doesn't cost, that doesn't have a specific dollar amount on the balance sheet. Or on the income statement or business model, revenue or cost. So the analogy in the business world would be goodwill, if you've heard of that in an accounting world. Brand value, right? These are non-monetary assets that businesses have. And your sweat equity is a non-monetary asset. You can pay yourself out of an investor's, there's a point in your business where maybe you can do it on weekends, like I described. There's a point of the scale of a business where you might just need to get paid by the business to keep growing it. So you're investing sweat equity at the beginning, holding on to that part of your equity stake in the company. And then if you're getting paid, that will reduce how much you can ask for in terms of equity in the company going forward, because now you're taking part of the cash as you go. I'm not sure that answered your question, Aaron, but I can give more examples of goodwill and brand value if that is useful as an analogy to sweat equity.
Thanks. No, that was helpful. I mean, if you have any links, I would take those too, but that was helpful.
Yeah, so sweat equity never appears on the balance sheet. It's not an accounting term.
There's no line item for
There's
that.
no line item for sweat equity. It's just kind of the plug. It's the value of your business, apart from the cash that you're putting into it. You're creating value by your sweat equity.
Right. So it would show up on your owner's table, perhaps, like.
Not as a dollar value, but
Okay.
so if you're the founder, if you came up with the idea, actually think about it this way. J.K. Rowling wrote books, right? Still writes books, but wrote books. Didn't get paid anything for the first one until she was done with it. The entire value of Harry Potter's first adventure was her sweat equity. She created it.
Okay, I see.
Yeah. So you don't know the value of your sweat equity until someone is willing to pay you for it.
Got it. Okay.
Yeah.
Great. Well, we really appreciate you being here, Jim. This has been a really great workshop. We'll go ahead and post this online. I just wanted to give out just a couple of reminders for those of you who are wanting to enter the competition. Here's the link to the Big Bang website. March 3rd at 1 p.m. is the magic date and time. I highly recommend submitting your materials by March 2nd. So that way, if you hit any technical issues and glitches, we have time to help you out because we cannot accept late or emailed submissions at all. We're also going to be posting on our Startup Tree event website. I'll be doing an info session for Big Bang at this time next week, so February 26th at noon on Zoom. It'll be a half hour for just me to go over the basics of the competition, answer any questions that you might have. So if you're interested in that, keep an eye out for that on our social media and our LinkedIn page. And then I will be available to you. Let me put my email address in the chat. I'm available to you should you need anything between now and then at all. So thank you all for being here and take care. We'll see you soon.
Thanks, everybody.
Thank you.
Bye now.